Great. Okay. Welcome, anyway, everyone, to another edition of CFA Society Chicago Macro Matters podcast, where we cover the macro that matters. My name is Rich Excell, CFA Society Chicago member and host of this program. And I'm lucky today to be joined by someone I've known for a long time in the markets. And I say that to mean that I'm old, not that he's old, but he's covered things a long time as well, and from a lot of different perspectives. And as I was thinking about the disparity perhaps between bond markets and equity markets, et cetera, Barry is the first person I thought of that could maybe help us understand what's going on and help us understand what we need to know. And so that's the founder and CEO or founder and director of research of Ironsides Macro, Barry Knapp. Thanks for joining me today.
Yeah, nice to join you. So shall we start with a broad discussion of the Treasury market and how
Yeah, so like I said, I was looking at it. We saw a big move from the September FOMC meeting up even before the election. Bond yields, 10-year yields moving much higher. It looked like inflation expectations were moving higher. Term premium were moving higher. Equity markets seem to be stumbling a little bit, but now, of course, post-election, they've ripped higher. So is there a disparity in how bond investors and equity investors are thinking about it? Do you think there's different paradigms, different factors they're looking at? Or how are you trying to think about that bigger discussion, Barry?
Yeah, from a little bit of a tactical perspective, I would say there's been something of a convergence in as much as, when we were in the August time period, early September, but up till the point of the FOMC meeting, quite frankly, we'd seen what I would consider a very clear deterioration in the labor market, and one that went beyond just the headline figures. And so one of the broadest views I've had about the last couple of years, as it was, with respect to policy and how it's impacted the economy and markets, is that the Fed absolutely butchered the tightening, easing and the tightening cycle. And so where I'm going with that in particular was in 2021, we had an additional 1.5 trillion in liquidity injected into the system through the Fed continuing to purchase treasuries and mortgage-backed securities at a point when clearly the economy was stabilizing. We got another additional 1.7 trillion of liquidity injected into the system in an even shorter time frame, pretty much from the point when Janet Yellen sat down at her desk through September, when she stopped issuing treasuries. People dunked on Stan Druckenmiller for saying she should have extended duration. She just stopped issuing, and Steve Mnuchin had left her 1.7 trillion in the Treasury General account, her checking account at the Fed, and she decided to just stop issuing and turbocharge that amount of liquidity into the system. And of course, then we know we had 1.9 trillion in fiscal stimulus, which included some 450 billion in checks sent directly to the public. So all of this was made possible by the Republicans losing the House or losing the Senate on January 4th, 2021. And we had a very sharp move in the 30-year real rate, the portion of the market least susceptible to either the Fed purchases or the Fed's rate policy. But it stopped when Janet Yellen just started injecting all this liquidity and cut her issuance. So all these things are going on. That was the primary cause of the inflation shock. I mean, you could look at things like core goods prices at the point when China was engaged in zero COVID, just absolutely explode from that point up to 12.4% peak as we created this fiscally driven demand shock and monetary shock at one point. So, okay, I think we all agree the Fed made a monstrous mistake at that point. But when they decided to unwind the policy, although the vast majority of their easing had been through the balance sheet, they decided, for reasons that I think were ridiculous, but things like, well, the public will better understand what we're trying to do, by primarily tightening through rate policy and only passively unwinding their balance sheet. This, of course, led to the longest inversion, which persists, of the 3-month bill 10-year Treasury, which is, call it the rough proxy for the banking business model, right?
Yeah.
Banks out in Illinois or in Colorado, take in deposits and lend out long. So this is the longest yield curve inversion of that part of the curve. And we've only had 3 other curve inversions this deep in our history, 73 to 75, or in that 73 period, 1980 during the Volcker regime, and then again this go around.
So, I mean, do you think that, I mean, I don't want to get ahead of it, but do you think that that inversion has kind of led to what a lot of people are saying is kind of this disparate outcome, the haves and have-nots, where maybe larger companies that have access to capital markets, maybe were flush with cash ahead of time, have done a lot better, whereas small companies were reliant on bank funding. Banks, we saw the banks being less and less willing to make loans. Of course they are, because their margins are going to zero. You know, is that really kind of led to this kind of bifurcated economy that we have, you think?
100%. It's true in the household sectors, where if you owned assets, your home or stocks, because of that continued suppression of longer term rates and term premiums, those assets have done really well. But if you're a household that didn't benefit from that, the inflation shock was much larger than the relative wage shock. And by the way, those wages, as measured by the Atlanta Fed wage tracker by quartile, you got a period of outperformance for the bottom quartile. They are now much worse off on a relative wage growth perspective than they were during the Tax Cuts and Jobs Act end of the last business cycle. So at the household sector, for sure. At the business sector, that's definitely true as well. Now, if we use ADP as our measure of employment, businesses with 49 employees or fewer, that employment growth is 0 right now, like 0.1% or so.
Okay.
For businesses with more than 500 employees, it's over 3%, about 3.25%. So that really highlights that. Now, of course, we know the way the BLS measures this is they use this infamous birth-death model, guesstimating how many new businesses were started, send out a survey to 119,000 companies. 9 months later, they go through IRS records across 13 million businesses at the state level, known as the quarterly census and employment and wages. And lo and behold, last August, we figured out that there was 818,000 fewer jobs in the year ended March. So if you assume that didn't get any better since March, and there's no way it did, at least logic wouldn't expect that. So we roughly, you could take the current payroll number and subtract 68,000 from that every month, which means, of course, August employment was actually negative in the private sector. If you adjust for that, employment growth in the private sector is less than 70 basis points per annum right now, which every time in the past we've fallen below 1%. In 91, in 01, and in 07, we were either in a recession or pretty damn close. So they'd done some real damage, and that was the view that we were at when we came into that September FOMC meeting. So I am not in the camp that they made a mistake when they cut 50 basis points. We need to get the policy rate to at least 4 to painlessly disinvert the curve. Now, of course, we know what happened to September payrolls. We had this tremendously strong report that combined with the benchmark revision to the national accounts data, which showed that gross domestic income, which I consider a better measure of output than gross domestic product, went from roughly 4.5% in the first half of the year nominally to 6%. So the Fed gets that number, then they get this 250,000 increase in payrolls, which, by the way, has subsequently been revised a bit, and I think is going to be revised quite a bit more, and I'll explain why. And then, of course, we get a strong retail sales number that also, to me, looks pretty dubious, for the same reason that the September employment report jumped. And now that we're all talking about, hey, maybe the economy's super strong here and the Fed shouldn't have gone 50 and, things are really strong. Well, let's think a little bit about what happened in September. First of all, I'll do a little more history because I love that stuff. That's why my brand is It's Never Different This Time. But the world came to an end in September of 2008 when all of us managing directors at Lehman and all the rest of the employees were the only ones stopped out at 0 during the financial crisis, right? So what that did, though, to the data was for the next 5 years, employment data was decidedly weak in the third quarter and strong in the fourth quarter. And that's because of seasonal adjustment factors having been corrupted by the Lehman bankruptcy, and their attempt to smooth it essentially made the data look weak in the third quarter and made the employment data look strong in the fourth quarter. The Fed took forever to figure this out and kept easing in response to that weakening of the data in the third quarter. We had QE2 launched, Operation Twist, and the reinvestment, QE3, all launched as a response to the weakening of the labor market data in that third quarter. So here we go, pandemic. In the 16 to 24-year-old age cohort, the employment ratio, which is the cleanest measure, not participation rate, but employment ratio, jumped sharply in the month of September. That's the month students go back to school. Well, in 2020, they didn't go back to school. And in 2021, they kind of didn't go back in a lot of places either. So my thesis here is the seasonal adjustment factors have been completely corrupted by the pandemic, much the way they were by the global financial crisis. The same situation is true of retail sales for the month of September, which looked decidedly strong. Typically, sales fall off as the back-to-school selling season ends. But if you look at those numbers on an unadjusted basis, you realize the seasonal adjustment factor that bumped those numbers up in September was the biggest seasonal adjustment factor, in like 10 years, right? So Again, this is all data smoothing, not government lying, but, just flaws in government methodology, right?
Yeah.
So I don't really believe there was a big bounce in the labor market, in which case we're going to find out a lot more about that with the November report in early December. And I think the Fed will go again in December, probably go again in January. Then they pause to see what the real fiscal outlook is going to be. But if you think about that just growth narrative changing so dramatically because of the GDI revisions, because of that September employment report, and because of retail sales, a little firmer inflation numbers, but inflation was always going to flatten out here. We still have, in my view, we have a fiscally driven problem in the Supercore series, non-housing services. We're running government spending at 24% of GDP. That is the fiscal theory of the price level. Anybody telling you Arthur Burns caused the great inflation is one of those like teachers, the lies my teachers told me or something. Like it was driven by fiscal policy. So we still have problems there, but the real growth, growth got stronger. So during that sort of period, right, when equities are doing a little better and the bond market is selling off, we're kind of in synergy with the current narrative. But the bigger, broader issue for me is can we slow the supply of treasuries, right? Because when you start talking, and this is sort of something I would definitely envision you looking at is, right, look at the supply of equities versus the supply of treasuries, right? Buybacks relative to CapEx have come down, but buybacks are still a big factor in driving demand for equities, shrinking the supply, and treasuries supplies going up. And we know in the first quarter, the financing needs have gone up a lot, but treasuries once again decided, let's just roll the dice on the Fed being able to cut all the way back to 2 3/4 or something and do something like 40% of our issuance in bills. So for me, there's been 3 episodes here that have really sent a warning sign that we are reaching our fiscal limit. The first one was the first quarter of 21, when, as I described earlier, 30-year real rates were on the run. I mean, they went up 60 basis points on a line from that day, January 4th, happens to be my birthday, so I won't forget the date, until the signing of the tax or the American Recovery Plan, and Chair Yellen decided to really cut issuance in April in particular. Like liquidity was just getting drained because she just stopped issuing, right? And then the Fed continued to buy $1.5 trillion. Well, the second episode, of course, was last year when the Treasury announced, hey, we got an additional $500 billion of coupon securities to sell in the second half of the year, and 10s went straight to 5%. course, we know how that one stopped. The Fed pivoted, and Treasury went to this what Steve Moran calls active Treasury issuance, and they ramped up bill issuance. That, of
Yeah.
course, forced the Fed to slow QT, but that's kind of a different related story. But they basically stopped the move in rates then. Well, we're in a very similar spot now, where it seems to me that in order to get the budget under control, and there's only one way to do it, you can't tax your way out of this. Tax receipts are within 4 basis points as a percentage of GDP of their post-World War II average. But spending's at 24% of GDP, 4% above its 50-year average. So the only way to get it, to get the supply of treasuries to come down is to bring spending back to 20% of GDP. Had Harris been elected,
Yeah.
I don't think we would have any chance of reducing the level of spending to GDP. We may under Trump.
Yeah, there's a couple things I want to get to on that. For one of them is the new Doge, I guess you would say it. But also before we kind of talk about this cutting the spending, that idea that you talked about, like even highlighting like the second incident last year when yields got up to 5%, and then there's a shift to issuing bills, et cetera. Is there a level on rates that Treasury, Fed, et cetera, are watching where they know that this is not sustainable and we have to change how whether it's where and how much things are issued, or QE versus QT, accelerate versus slow down? How, is there a level that they have in mind, or are they looking at what indicators are they looking at besides just the level of rates?
I think they'll do it as long as they can get away with it. And had I been in Chair Powell's press conference last week, the question I would have asked him is, hey, you cut 50 and 10s went up 75 basis points. You think you might be losing control here, even though the way you're doing QT is you're continuing to roll longer duration stuff, and you don't own any bills, even though you had a bills only policy from 1951 until 2008, and Treasury's issuing primarily in the front end 20% greater than the Treasury Borrowing Advisory Committee suggests, and you're still losing control? You think we might have a fiscal, accident waiting to happen?
Yeah.
That's a question I would have asked. And
No, and that's completely fair, right?
right. And the answer to me is
No,
yes.
go ahead. Sorry.
I mean,
Good.
we're headed down a bad path here. Now, listen, I think there is first of all, before the election, a key element of the Trump trade, the one that most people had the highest confidence in, was the idea that he was going to drive yields higher, right? Blowing out the deficit. As I intimated before, cutting corporate taxes is non-inflationary. It's not going to blow out the deficit. Tax receipts as a percent of GDP are endogenous to growth. They've been stable regardless of tax policy since World War II. Spending is exogenous. It's set by Congress, and that is the bigger issue. We have the continuing resolution expiring on December 20th. Presumably, Congress will do another continuing resolution to push it to the next Congress, in which case, if the Trump administration is serious in making the Tax Cuts and Jobs Act cuts permanent, they will need to find a revenue offset, because the Byrd rule balanced budget provision says you need to have it. That's why both the Bush tax cuts of 2003 and the Tax Cuts and Jobs Act of 2017 had a born-on date, right, or an expiration date. This time, if you want to make them permanent, you either have to come up with offsetting revenue or offsetting spending cuts. Now, if they integrated a reciprocal tariff, I'm not even sure they could get that done. I doubt that the Joint Committee on Taxation, subsidiary of the Congressional Budget Office, would score that as sufficient to offset those tax cuts, in which case they need to come up with spending cuts. Now, before the election, everyone said, oh, neither party's interested in spending cuts, and Trump's a big spender anyway. And maybe, but Trump's expenditures during the first 3 years of the Trump administration were 20%, right? Even when he broke the Budget Control Act 2% spending cap deal with Pelosi and Schumer after he passed the Tax Cuts and Jobs Act in probably March of 2018, spending that year was still only 20.6% of GDP. So didn't really spend that much during the Trump years. It went to 30 in 2020 with all the pandemic relief, stayed there in 2021, and then it went to 24, and CBO projects it at 24 from now through the end of time. All of Trump's surrogates, Howard Lutnick, John Paulson, Scott Bessent, Elon Musk, they're all talking about spending cuts. And I think that's where we will wind up is, them at least attempting to make those cuts permanent, offset by spending cuts, in which case maybe we can stop the supply of treasuries. For me, the only way we can really stabilize our debt is if we start running a primary surplus again, which is receipts less expenditures X interest expense, right? So that core spending measure. And that's what we did from the end of World War II through the late 60s or middle 60s. And that's how we stabilized the debt ultimately.
So to do that though, you would have to get it from 24% to spending. I mean, you said 20% is the average, but you'd have to go even a little bit lower than that, wouldn't you, to get to that core surplus?
To be able to run a primary surplus, yeah, you'd have to keep going. And in order to do that, I know everyone says, well, we've got to go into entitlements, and that's true. But the way that's generally characterized is we have to get to eligibility. And I'm not so sure that that's actually the case. Listen, I'm not a healthcare expert, but healthcare expenditures are growing really rapidly. And our entire healthcare system is pay for services, not health and wellness. I think you can change the incentives in the system and bend that curve. There's lots of people talking about it, including RFK. These are not crazy ideas. This is how, I live my life. Lots of other people do as well. It's
sure.
I want to live a long time, keep skiing this mountain over here and playing golf, and that's how you live, right? And
right.
Anyway,
and if you're on a high deductible plan, and that's how people they talk about the incentives, like if you're with those who are spending, who are in control of their spending, they look at that kind of preventative measures, et cetera, and as the incentive to keep those costs lower.
Right. But anyway, between, if you think then back to our original question of stocks versus bonds, and the outlooks here, I just had a call with a client. A family office, and we just discussed the same sort of stuff. And I said, listen, at 4.5%, I think Treasury market's okay, sort of fairly valued for now. I wouldn't entirely be shocked if we didn't have another test of 5% that forces the issue on the spending cuts that I'm discussing. That seems reasonably probable, in which case the equity market will not take too kindly to that, particularly if it happens quickly. As we all know, you and I being derivative people, the rate of change matters a lot, right? And so
sure,
I do think that's still a risk. And I think that the other big risk I would cite is the dollar, which can be an absolute wrecking ball to global liquidity. If China tries to devalue their way out of tariffs, they get outflow pressure and a run on the RMB. They were intervening on behalf of the RMB the day after the election. China, Germany, Japan, Korea are all short oil, and the US is now a petrocurrency. So, if the war in Ukraine and Russia isn't settled by the time Trump is inaugurated, and we have any more pressure there, and we cut off Iranian oil to much of the rest of the world, tighten the screws on that, energy goes up and the dollar goes up. Big problem for Germany, big problem for China, big problem for Japan. So again, that's a source of risk. As far as the equity market itself goes, and I get the equity risk premium, the earnings yield less the real 10-year Treasury yield is about as low as it's been. I sort of set aside the last cycle because of all the Fed's rate suppression, where stocks might have been rich, but bonds were ridiculously rich, and they still are in some sense. but that equity risk premium is pretty low. Now, again, there's an old saying about averages, right? You put your rear end in the refrigerator and your head in the oven. On average, your body temperature is 98.6, but not a great outcome, right? So we know that anything to do with Gen AI is really rich. But the energy that's going to power Gen AI is not really rich. And one of the Trump trades was drill, baby, drill. You're going to drive the price of oil down to $50. That's ridiculous. Shale fundamentally changed the elasticity of supply of energy, right? It used to be you drilled a well in the Gulf of Mexico. It took you 3 years. If you plugged it, it was gone. Now you start a fracking well in 3 weeks. If the price of energy falls, you just close it down. You can always restart it. So oil companies are not going to drill themselves into oblivion like what happened in 14 to 16. What we really need is to build out the infrastructure around energy. So those plays are not expensive. The financial sector, listen, I think the absolute worst thing that happened to the financial sector since Lehman went bankrupt was Basel risk-based capital rules.
Yeah.
It basically turned banks into the big banks into big government bond funds. Zero risk weight on govies, pushed the mortgage business out of the sector, pushed private sector lending out of the sector. That's why private credit has exploded. Now, some advantages to private credit in terms of matching duration and all, but listen, you basically push the banking system out of it with this risk-based capital requirement. So I think that's the Basel end. It's the end of the end game for Basel, right? The Basel end game. So parts of the equity market aren't necessarily nearly as expensive. The equal weight isn't as expensive. And I would say more broadly too, there was a real weakening of capex in every area in this economy except for Gen AI. And Finian the other day said every bit of our semiconductor business is weak except anything to do with Gen AI. But when you look at like Fed regional manufacturing and non-manufacturing services surveys, the current levels of capex orders and employment are weak, but the 6-month forward plans are pretty strong. I think they were waiting for an election result. This one will likely boost business confidence, and we may get a better mix of growth in 2024. I wouldn't think growth would accelerate, but I think we'd rather have 80 basis point contribution from government spending go to more like 10, and capex go from, 40 to 1.25, something like that, and just have a mix of growth that will actually drive productivity and efficiency over time. And so that's what complicates that question about, are the markets aligned or not?
No, that's fair, and I think you've touched on it a little bit, and I know you've kind of written about this before, but you kind of talked about the 51 to 81 scenario, and I think some have kind of talked about the risk of reignition of inflation. We see more and more people, moving more towards the kind of still not maybe consensus, but certainly leaning more towards the no landing scenario versus even soft landing. So in this where the Fed is easing, and I know we talked about the bifurcated economy, et cetera, but what is the risk of a reacceleration of inflation, from the Fed easing because of some of the other problems that you've talked about, the other risks you've talked about? But if we do really kind of see ultimately no landing and a different mix shift, is that something that's on the table? I mean, I'm kind of the opinion that for policymakers, whether they're tacitly admitting or not, inflation is their goal because they've got too much debt and they really don't want to reduce the debt. So inflation is their only way out of it. But I don't know how you feel about that.
I think that's right, in a sense. I mean, what I really think they should be targeting is the standard deviation of inflation with some upper limit, not 2%. That's a ridiculous goal. Right now, the standard deviation of CPI is about 34 basis points. The median level since 1947 is 58 basis points. The median level of headline CPI is 3%. We're at 2.6. So to me, it looks like price stability right now. Should be fine. That's what they should be managing towards. Trying to push it down to 2 when they're putting this degree of pressure on small banks and small businesses is a really bad idea. But if we just step back and think about the inflation outlook, we'll use Chair Powell's framework, right? Core goods, non-housing services or supercore, and then housing services. To me, the Fed did so much damage to the housing market by continuing to buy treasuries, collapsing or mortgage-backed securities, collapsing that spread between mortgage-backed securities and treasuries to all-time tights, which attracted private equity capital into residential real estate, allowing this massive refinancing wave. They actually impaired the supply side of housing more than they weakened demand. So we already had a structural problem. They've exacerbated it, and there's no easy way out. So, sure, right now current rents have come down a lot, but look at the construction of multifamily units. They peaked at 1 million before the Fed got started. They're at 318,000 or something like that. Rents are coming down now, but in another year or two's time, rents are going to be growing faster than they were pre-pandemic. So I don't really see that housing measure returning to 3%. And that's where it was pre-pandemic, not 2, it was 3. Okay. Yeah. Then you have non-housing services. Now there's some elements of that are just lagged effects of the inflation shock, insurance, that sort of stuff. But that's where you're seeing the fiscal policy spending at 24% of GDP. Those businesses, theoretically, at least their biggest cost is wages. We're in a situation where government wage growth is running 100 basis points above private sector wage growth, something that's only supposed to happen during recessions. Government employment growth is running 100 basis points faster than private sector employment growth, something, again, that's only supposed to happen during recessions. The only way to really get that piece of inflation, which is running at 4% right now, in the CPI measure, back to its pre-pandemic trend of 2.5%, is those fiscal, that fiscal scenario I was talking about, which admittedly is a little optimistic, but getting that under control. And then we have goods, of course, and that's where people assume tariffs are going to push the rate of inflation up. I don't think that's the case. And China's got nowhere else to go with their product. Germany's got nowhere else to go. Japan, Korea, they're going to have to absorb the costs. And as I said, they can't really just weaken their currency because it creates a problem with energy prices, which they're short, and the dollar is a petrocurrency, and because China might have outflow pressures. So I don't really see goods prices starting to be an inflationary risk. So what I'm left with is a couple of pieces of intractable problems that probably mean that core CPI is 3+ for the foreseeable future, and then we'll see whether we can avoid the 60s scenario where that fiscal piece just keeps driving up housing costs and non-housing services or not.
And I think you're right that's probably the one piece that was maybe discussed a little bit, but I don't know how much credence people gave the idea of cutting spending. I mean, I think going in, my read was that many investors were thinking that regardless of who won the election, deficits were going to increase under either one of them, maybe for different reasons. But now, just in the last, since the election, here we're November 13th or whatever, so a little more than a week later, and now I guess yesterday we got the announcement that Elon and Vivek are going to be the Department of Government Efficiency, and we're going to cut spending, and it's going to, all going to be done before July 4th, 2026. Is this something that, I mean, certainly it makes great headlines. Certainly there's a lot of people that are fans of Elon that are optimistic that he can get this done. If anyone, how plausible should we be thinking about this? Of course, from a market standpoint, from a tradable standpoint, yeah, we have to respect that. Certainly in a strong seasonals of Q4, people are going to be maybe focused on a little bit. But as we look into Q1 of next year, is this something that we should be taking credibly? What should be that we should, what are the kind of the timeline or lines of saying we should be looking at that the markets are really starting to believe that this can happen?
Right. Well, here's the signposts. The continuing resolution that funded the government for this year expires on December 20th. Okay, so what does Congress decide to do? Most likely, there's another continuing resolution not a big omnibus spending bill that jams a whole bunch of spending in and locks in spending at high levels for another year. Wouldn't think that would be likely. If you see that, then I guess you got to worry a little bit more about the bond vigilantes if they
Yeah.
do an omnibus. If they do a CR and roll it till March or April, and then they immediately begin negotiations on the tax cuts and the budget, what if you recall back in 2017, the Trump administration, I think, made a major tactical error by beginning with Obamacare, you know, what was it? Something and release, whatever, end Obamacare, however they were going to go do it, that McCain ultimately killed in August of that year. And then the second legislative agenda item was the Tax Cuts and Jobs Act. So by going after, repeal and replace. I don't know why.
Oh, okay. Repeal.
Senior moment on that one, I guess, right? But by first focusing on repeal and replace and pushing that Tax Cuts and Jobs Act, that didn't get done till the end of the year. I think this is going to be the first legislative piece of business because of if they have a CR that goes to March, they have to get it done by March. And as I said, the Byrd rule provision of that, which says it needs to balance over the 10-year time horizon, will force them to identify spending cuts immediately. So this whole thing could happen relatively quickly. If it does, then the market may be willing to look through the current reasonably heavy supply of treasuries in the first quarter of the year and think, okay, we're actually on a sustainable fiscal path. But as I said, there's alternate scenarios here. An omnibus spending bill that pushes the whole thing out for a year, and then they just spend a year talking about what they're going to do about tax cuts next year. That would also, by the way, if they did it the way I suggest, and they, have a teaser rate in there at 15% for domestic companies, that could actually cause a pretty big boost to small business confidence as well, which is the part of the economy that's struggling with this tight supply of credit and deeply inverted yield curve. So there could be real benefits to doing it that way that would cause a bit of a growth burst. But again, I'm not one of the candidates for Treasury Secretary. So
no, I hear you. And I mean, do you think the markets have a strong view on who they would prefer to see of the names? I think the ones you mentioned, Ludnick, Paulson, and who, I forget who's the third one that was
Scott Bessent.
Scott Picento. Yes, right. Does the market have a preference? I mean, Trump's already surprised us with some of his announcements, but
Paulson pulled out.
Okay.
Partially because of supposedly because of his Fannie and Freddie investments, which we could talk about because they need like 200 billion of capital to, recap and release. And I don't know where they're getting 200 billion of capital, but anyway, I know people love that trade, but it's a wacky one. So Paulson's pulled out. It really comes to Bessent and Lutnick. I don't really know Lutnick that well. I've read a lot of what Bessent has said. I know what Lutnick does, obviously, pretty well, being CEO of Cantor, having spent all those years at Lehman and Barclays. So I'm not sure there's a preference there. Bessent's got some ideas around the Federal Reserve that may make some market participants nervous. That's a whole other line of discussion. I think ultimately we're going to wind up with a Kevin Warsh as the Fed chair next go around. Hassett maybe, but Warsh more likely. And Warsh to me would be a guy that wants to shrink the Fed's balance sheet and get them out of the long-term interest rate setting business, which would be, I understand it may be tough to get there, but it would be wildly bullish for productivity and growth over time to let the market determine where the most important price in the global capital market system, the 10-year treasury should be. Not the overnight rate. It's the rate that capital gets allocated based upon. So, but yeah, I guess I'd probably think the market would prefer Bessent, in fact, because he's been so vocal about his ideas and his policy objectives, and Lutnick hasn't really said what he would do.
And then, I know we talked a little bit about spending. I just kind of want to get one last kind of question in here. respect your time here, Barry. I know you mentioned before kind of negative swap spreads. You mentioned before kind of like the excess issuance. Are there any surprises we should be looking for, expecting in terms of how much and where treasurers are issued? I mean, I know a lot's going to hinge on what we can do in terms of funding the tax cuts, the spending cuts, et cetera. But just in kind of what's already been announced and coming out, any potential surprises we should be looking for?
Well, you know, we had the borrowing needs announcement from the Yellen Treasury, and then we had the quarterly refunding announcement, and they decided to not increase note or bond sizes through the first quarter. A new Treasury secretary gets confirmed, sits at their desk sometime in February, starts hiring people. I can't imagine they're going to make any changes to coupon sizes, between now and the second quarter at the earliest. And at that point, are they really going to want to increase coupon sizes unless we've already taken these steps on spending and we've had a ferocious rally at treasuries back into the three handles? At that point, they might say, okay, let's start terming this out, stop rolling the dice on bills. Because, well, here's an important related point to this for people that really follow this stuff closely, which is the Fed RRP program, which is the first line of liquidity, if you will, fell from roughly $330 billion at the time of the September meeting. Now it's bouncing around somewhere in the 150 area. The Fed's taking 25 billion of treasuries out per month, but Treasury's issuing a lot of securities as well. Once that goes to zero, we'll be watching bank reserves really closely. In the first quarter of the year, as I said, with the Treasury increasing bill issuance so much, that's going to drain those balances really quickly. The last couple of days, we heard a speech from Roberto Perli, who is in charge of the SOMA portfolio for the New York Fed, insisting that they can keep going on QT. Logan didn't say too much about it. She's sort of the second expert in the lot. I don't know exactly how to read Neil Kashkari's speeches on this. He said the hurdle to end QT is really high. So I don't know whether he's repeating what was said in the meeting or that's his own opinion. If it's the former, it's credible. If the latter, not so much. But this is a real question that we could run into in the first quarter as well. Is the Fed forced to end QT? If the Fed is forced to end QT, the first market reaction is going to be, like equity investors and all people that are casual observers buy it, right? Like QT's over. This is great. The Fed has some decisions to make when that happens. The first one is, what do they do with runoff in their mortgage-backed securities portfolio? They've already said they're going to reinvest into treasuries, but do they shorten the duration of their SOMA portfolio, or do they hold it constant? Kansas City Fed President Schmid has been quite vocal about this and is saying they need to shrink that duration. Go back to, these are my words, not his, go back to that bills only policy that was in place from 51 to 2008. Logan said they should start shortening the duration as well. They all hold almost no bills. And they seem to think that if they do a survey and everyone agrees about the terminal size of the SOMA portfolio, then it has no impact on rates. That strikes me as ludicrous. How can they hold 20 to 25% of the outstanding stock of treasuries and mortgage-backed securities and it doesn't affect the price?
Right, for
Of course
sure.
it does.
Yeah.
And they keep rolling into longer-term securities. Every time I see a 10-year auction, and then there's a headline a few minutes later that the Fed bought $6 billion in the open market, I'm infuriated, right? And so that's the questions that are coming up with respect to the Fed's balance sheet in the first quarter. And that'll really affect what happens with issuance and supply too. And so, again, that's a little in the weeds, a little technical, but I think those are really good signposts for people to be watching as we get past the end of the year into these whole budget discussions.
That's awesome. Well, Barry Knapp, managing partner of Ironsides Macro, founder as well. Thanks so much for kind of coming in and getting in the weeds with us a little bit. I know you can go deeper in the weeds, but for our audience, I think this was plenty deep enough. So I really appreciate it, kind of bringing this holistic view of everything that's kind of going on, the signposts of what we should be looking for, et cetera. So thanks very much.
All right. Thanks, Rich.